We often hear about the assets and investments the rich pursue, but have you ever wondered what they avoid? From risky ventures to speculative schemes, the wealthy have a keen eye for avoiding financial pitfalls that can drain their hard-earned money. By understanding their strategies and applying them to your own investment portfolio, you can elevate your financial game and set yourself up for long-term success. In today's video, we're diving deep into the world of finance to uncover the 7 things the rich never invest in. We'll delve into their mindset, their strategies, and the principles they abide by when it comes to wealth creation. From real estate to high-risk ventures, we'll unveil the investments that don't make the cut for the elite. Welcome to the General Finance Channel, where we're committed to helping you take control of your finances. Are you tired of feeling overwhelmed by credit card debt, unsure of how to create a budget, or intimidated by the world of investing? Don't worry, we've got you covered. Our channel is dedicated to providing you with practical tips and insights on credit management, budgeting, and investing. We upload new videos 3 to 5 times per week, so you'll always have fresh and valuable content to help you achieve your financial goals. If you like what you see, make sure to hit the like and subscribe button, as well as the notification bell so you never miss out on our latest uploads. Let's start our journey to financial freedom together, right here on General Finance. Investment number 1. Digital currencies. Digital currencies, also known as cryptocurrencies, are digital or virtual forms of currency that utilize cryptography for secure transactions and to control the creation of new units. While cryptocurrencies have gained popularity in recent years, they are generally not favored by the wealthy as an investment option. Today, we'll explore the reasons why the rich typically steer clear of digital currencies and why they perceive them as less desirable investment opportunities. One primary reason why the rich are hesitant to invest in digital currencies is the lack of government regulation. Unlike traditional currencies issued and regulated by central banks, cryptocurrencies operate on decentralized networks and are not backed by any government or financial institution. This absence of regulatory oversight raises concerns about the stability, legitimacy, and legal framework surrounding digital currencies. Another factor that deters the affluent from investing in digital currencies is the absence of inherent value. Unlike tangible assets such as real estate or commodities, which possess intrinsic worth or utility, digital currencies derive their value primarily from market demand and speculation. This volatility and lack of underlying value make them inherently risky and less attractive to conservative investors seeking stable long-term growth. Additionally, the risk of hackers and theft is a significant concern when it comes to digital currencies. The decentralized nature and the reliance on digital wallets and exchanges make cryptocurrencies vulnerable to cybersecurity threats. Hacking incidents and fraudulent schemes targeting digital currency platforms have resulted in substantial financial losses for investors. These security risks further erode confidence in digital currencies as a safe and reliable investment. Investment number 2. Bonds. When it comes to investing, the rich have a keen eye for opportunities that can maximize their wealth and generate substantial returns. One investment vehicle that doesn't make the cut for the affluent is bonds. Bonds are often considered a safe and stable investment option, as they provide fixed interest payments over a specified period. However, the wealthy understand that the potential returns from bonds are relatively limited compared to other investment options available to them. While bonds may offer security, they often fall short in terms of wealth creation and capital appreciation. One key reason why the rich steer clear of bonds is their relatively low yield. Bonds typically offer lower interest rates compared to other investments, such as stocks or real estate. This lower yield restricts the potential for significant wealth accumulation over time. The affluent recognize the importance of maximizing their returns and seek out higher-yielding investment opportunities to achieve their financial goals. In fact, according to recent statistics, the wealthy allocate only a small portion of their investment portfolios to bonds. On average, high-net-worth individuals allocate less than 10% of their portfolios to fixed-income investments. This highlights their preference for more lucrative and growth-oriented investments that can generate substantial wealth over time. Instead of relying heavily on bonds, the rich often opt for investments with higher potential for capital appreciation and income generation. They diversify their portfolios across various asset classes such as stocks, real estate, private equity, and alternative investments. By spreading their investments across these opportunities, the wealthy can tap into higher returns and unlock the full potential of their wealth. Investment number 3. Companies you don't understand. The rich, including prominent investor Warren Buffett, often emphasize the importance of investing in companies they understand. This approach reflects a concept known as the circle of competence, which refers to sticking to investments within your area of expertise and understanding. Warren Buffett, one of the world's most successful investors, has famously stated that he won't invest in businesses he doesn't understand. This principle highlights the idea that a deep understanding of a company's operations, industry dynamics, competitive advantages, and financials is crucial for making informed investment decisions. Buffett believes that if you cannot grasp how a business operates, it becomes challenging to accurately project its future performance. The circle of competence concept suggests that investors should focus on areas where they have expertise or experience. By staying within their circle, investors can better evaluate the potential risks and rewards of an investment, making informed decisions, and mitigate the likelihood of significant losses. It allows them to leverage their knowledge and insights to identify opportunities and evaluate a company's competitive position, growth prospects, and potential pitfalls. The principle of if you don't understand the business, how can you project performance emphasizes the critical connection between understanding a company and making reliable projections about its future prospects. The rich recognize that accurate projections and forecasts require a deep comprehension of a company's products, industry trends, competitive landscape, and economic factors that impact its performance. Without this understanding, it becomes difficult to assess a company's growth potential, profitability, and long-term viability. Investment number 4, precious metals. While precious metals like gold have long been associated with wealth and value, the rich typically do not view them as a primary investment choice. First, it's important to note that gold and other precious metals can act as a safeguard against economic downturns and inflation. During times of economic uncertainty, investors may turn to gold as a safe haven asset due to its perceived stability and ability to retain value. However, the rich often rely on a diversified investment portfolio that includes a range of asset classes beyond precious metals to mitigate risk and optimize returns. One reason the wealthy are cautious about investing in precious metals is the adverse relationship between gold and the stock market. While gold may perform well during market downturns, it tends to have a negative correlation with stock prices. This means that when stocks are performing strongly, the value of gold may not experience significant growth. As a result, the rich focus on investment strategies that have the potential for higher returns and align with their long-term financial goals. Moreover, the price appreciation of precious metals like gold has historically been relatively modest compared to other investment assets such as stocks or real estate. While gold can act as a store of value over time, its price movement may not be sufficient to generate substantial profits during economic downturns. The wealth often seek investments that offer a higher growth potential to maximize their wealth accumulation. Additionally, precious metals including gold can be liquid assets. Selling physical gold or other precious metals can involve fees, logistical challenges, and potential price fluctuations. This lack of liquidity can limit the flexibility of accessing funds when needed, which is a key consideration for the rich who prioritize investments that provide liquidity and capital preservation. Investment number 5, collectibles. Collectibles are unique items that hold value due to their rarity, historical significance, or cultural importance. These can include artwork, rare coins, vintage cars, stamps, antiques, and other unique items. While some individuals may find joy and satisfaction in collecting these items, the wealthy typically refrain from considering collectibles as an investment strategy. One of the key reasons the affluent tend to steer clear of collectibles as investments is the subjective nature of their value. Unlike traditional investment assets such as stocks or real estate, the worth of collectibles is determined by the willingness of buyers to pay a certain price. This means that the value of collectibles can fluctuate greatly based on market trends, popularity, and the availability of interested buyers. Additionally, collectibles generally do not generate any income. Unlike stocks that offer dividends or rental properties that provide rental income, collectibles do not produce regular cash flow. The potential for income generation is an important aspect that the wealthy consider when making investment decisions to build and grow their wealth. Furthermore, collectibles are often illiquid assets, meaning they're not easily converted into cash. Selling a collectible item can be a time-consuming process that requires finding the right buyer, negotiating a fair price, and potentially navigating a specialized market. The lack of liquidity can pose challenges for the wealthy who prefer investments that offer flexibility and the ability to access their capital when needed. While collectibles can be appreciated for their beauty, historical value, or personal interest, they are generally not viewed as reliable investment vehicles by the wealthy. Instead, affluent individuals tend to focus on investment strategies that provide greater potential for capital growth, income generation, and liquidity. They often reallocate their resources to asset classes such as stocks, real estate, businesses, or other financial instruments that align with their financial goals and risk appetite. Investment number 6. Certificates of deposit. Certificates of deposit, or CDs, are financial instruments offered by banks and credit unions that allow individuals to deposit a specific amount of money for a predetermined period at a fixed interest rate. While CDs can be a low-risk investment option for some, they are generally not favored by the wealthy as a primary investment vehicle. One of the main reasons why the affluent may not favor investing in CDs is the relatively low returns they offer. Compared to other investment options such as stocks, real estate, or business ventures, the interest rates on CDs are often modest. While CDs provide a fixed interest rate, these rates may not keep pace with inflation, potentially resulting in lower real returns over time. Another factor that deters the wealthy from investing in CDs is the lack of liquidity. CDs typically have a predetermined term, ranging from a few months to several years, during which the funds are locked in. Withdrawing the money before the maturity date may result in penalties or forfeiting the interest earned. This lack of liquidity can limit the flexibility of the wealthy, who may prefer investments that offer more immediate access to their capital. On the upside, investing in certificates of deposit does offer some advantages. They provide a predictable and stable return on investment, which can be appealing to conservative investors who prioritize capital preservation and steady income. CDs are also considered to be relatively low-risk investments since they're typically insured by the Federal Deposit Insurance Corporation, or FDIC, up to a certain amount per depositor per institution. Investment number 7. Penny stocks. Penny stocks, often referred to as microcap stocks, are shares of small companies with low market capitalization and typically trade at a relatively low price, often below $5 per share. While some may perceive penny stocks as an opportunity to strike it rich quickly, the reality is that they come with substantial risks and are generally not favored by the wealthy. Today, we'll delve into the reasons why the rich would never invest in penny stocks and why these investments should be approached with caution. One crucial factor that deters the affluent from investing in penny stocks is the lack of regulatory oversight. Unlike companies listed on major stock exchanges, penny stock companies are not required to register with the Securities and Exchange Commission, or SEC. This absence of regulatory scrutiny means that there is often limited information available to investors regarding the financial health and operations of these companies. Without access to credible and transparent financial information, it becomes challenging to assess the true value and potential risks associated with penny stocks. Additionally, penny stocks suffer from low levels of liquidity, meaning that they are not bought and sold as frequently as stocks of larger, more established companies. This limited trading activity can lead to a lack of market depth and increased volatility. As a result, it becomes more challenging to execute trades at desired prices, and the bid-ask spread can be significantly wider, making it difficult to enter or exit positions without negatively impacting the stock's price. Furthermore, penny stocks are often subject to manipulation and fraudulent schemes. Due to the low price and lack of oversight, they can attract unscrupulous individuals who attempt to artificially inflate the stock's price through false or misleading information. This puts individual investors at a significant disadvantage and increases the risk of financial losses. As we wrap up our discussion on the 7 things the rich never invest in, it's important to reflect on the valuable insights we've gained. By understanding what the wealthy avoid when it comes to investing, we can learn valuable lessons and adopt their strategies to enhance our own financial journeys. Remember, investing wisely is not just about where you put your money, but also where you choose not to invest. The rich prioritize informed decision-making, thorough research, and a focus on long-term wealth creation. They steer clear of investments that carry excessive risks, lack transparency, or fall outside their circle of competence. As the legendary investor Warren Buffett once said, "Rule number 1, never lose money. Rule number 2, never forget rule number 1." This powerful quote emphasizes the importance of preserving capital and making sound investment choices. Thanks for tuning in to today's video on the General Finance channel. We hope you found it informative and valuable. Remember, we'll be posting new videos on the channel 3 to 5 times per week, so make sure to hit that subscribe button and turn on notifications so you never miss an update. And don't forget, we want to hear from you. Leave your thoughts and feedback in the comments section below. Is there a particular topic you'd like us to cover in a future video? Let us know. Thanks again for watching, and we'll see you in the next one. Keep building that financial savvy, and we'll be here every step of the way to help you on your journey to financial freedom.